Hey guys, welcome to another video. In this video, we'll be looking at how the stock market works. We'll go over basic questions like, what is a stock? Why does it go up and down? And why sometimes looking at a stock chart can be misleading. If you're new to investing or are interested in learning more about how to navigate around the stock market, then this video is for you. Remember to like the video if you find it helpful and subscribe for more content if you want to learn about the basics of the stock market. Let's get into it. When companies start up, they're usually private. What this means is that their founders are using their own money to build the company. If one day the company wants to get to the next level and raise a lot of money in a short amount of time, they will go through a process called an IPO. This is the initial public offering. So what is an IPO? An IPO is an event where a company goes from being privately owned to publicly owned. The private owners working with banks and other players come together to decide how many shares are going to create and at what price to sell them. Usually, the owners tend to keep a percentage of the shares, and the rest of the shares will be bought by the public. The company makes a lot of money in the process by selling ownership to people like you and me. Now, what that means is when you buy a share, in this case a stock, you're actually buying a small piece of the business. Oatly is an example of a company that's currently going through an IPO. They're a Swedish-based company that is making alternative milk products using oats. I personally enjoy their products and I actually see that they have a lot of potential as a company. After they go public, me and other retail investors will be able to buy their stock, which means we'll become part owners of the company. This is how stocks are created. Okay, so let's look at what it means to own a stock. Who's ready for math?
Let's take the example of a pizza. Imagine that a pizza is represented by an entire business. If you cut the pizza into 10 slices, then that's the equivalent of a business having 10 shares. Usually, public companies tend to have millions or even billions of shares, so just imagine teeny tiny slices of pizza. The price of a stock, as can be seen on Google or anywhere else, refers to the price of one of those tiny slices of pizza. The problem with looking at the price of a stock to value companies is that companies, just like pizzas, can have different amounts of shares or slices. A large pizza could be cut into 16 pieces, whereas a small pizza could be cut into 2 slices. In that case, the price of a slice would probably be higher for the small pizza. Let's take a real-life example. If you compare a stock of Coca-Cola to a stock of Pepsi, you could assume that Pepsi is a bigger and more expensive company. After all, shares of Pepsi are 3 times as expensive as shares of Coke. Well, that's not exactly true. This is simply because Coca-Cola has 4.3 billion shares, while Pepsi has 1.3 billion. If you really want to know how expensive a company is, you look at the market cap, which is here. The market cap number is equal to the number of shares multiplied by the share price. If you wanted to buy 100% of a company, all of its shares, to become the one and only owner of that company, you would have to pay the market cap. For example, a company having 1 million shares worth $1 each would have a market cap of 1 million. On the other hand, a company with 10 shares worth $100 would lead to a market cap of $1,000. Apple, which is the biggest company in the world, has a market cap of $2 trillion. Usually, any company with a market cap of over 10 billion is considered a big company. This is what's called a large cap.
Let's recap one last time using my pizza example just to make things a bit more clear. The market cap is the price you would pay to own an entire pizza. The stock price is what you would pay to own 1 slice of the pizza. This number can fluctuate depending on the size of the full pizza and the number of slices on that pizza. Pizza. It's important to understand that when you look up the price of a stock, all it tells you is the price of the one piece of that company. It doesn't tell you how many pieces there are or how big they are. You need to dig just a little deeper to find out how big a company is and how many of their shares exist. This is where things can become a bit more abstract. Stocks don't come with a price tag that we can all see. Stock prices are actually determined by the people buying and selling the stock at that specific moment. It can all be explained by supply and demand. If someone is willing to sell their stock at $10 and someone else is willing to buy it at $10, the price will be set at $10. If tomorrow there are no buyers at $10, but people are still trying to sell, the price will have to go down to the amount that somebody's willing to pay for it. Likewise, if there are no sellers at $10, but people are still trying to buy, the price will have to go up until someone is willing to sell it. It is important to understand this concept because the price of a stock can really be influenced by people's emotions. Sometimes a stock might actually be worth X amount, but because people are scared or don't want the stock, it will trade at a lower price. This usually happens during recessions like the one we had back in 2008, during the pandemic, or when companies are seen as undesirable. During these times, people typically take on less risk by either holding onto their money or selling out of stocks because keeping it in cash seems like a safer option. Other times, a stock can trade at a higher value than what it's worth. This makes sense when people see potential and actually expect a company to grow a lot faster. In that case, people would be willing to pay a bit more than what it's worth today, hoping that later on it will be worth a lot more. Same goes if a company is a big brand name like Apple or Microsoft. These big names provide stability and safety, so it could make sense that they're selling at a premium. However, if a stock is trading at high valuation because there's hype around the company, paying more for it might not be worth it and could lead to low returns in the future. So what's the point of all this information? Looking at a chart when trying to pick stocks tells us barely anything about a business. We normally want to know the size of the company, how fast it's growing, the number of shares available, and whether it's out or in favor. All it shows us is the evolution of what people are willing to pay for one share of that business. A lot of new as well as experienced investors look at a chart, goes up, and they think, oh, that must be a good investment. This happens because of FOMO, which is the fear of missing out. People will see a stock go up, FOMO will cloud their judgment, they're gonna forget everything they knew, and they just want part of the gains, so they'll put their money into it regardless of the value. I hope this video has convinced you that if the price of a stock goes up, it does not necessarily mean that it's a good investment. For example, if the price of avocados has gone up because they're trending or a lot of people are buying them, it doesn't mean that they taste better than before. Nothing about them has changed, only the price. When it comes to stocks, it even makes sense to say that if a stock has already run up, 1, there's a higher chance now that it is overvalued rather than undervalued, and 2, there's limited upside potential. If a company has doubled in size from 25 billion to 50 billion, in order to double in size again, it will have to be worth 100 billion. This goes to show that it's harder to grow when you're already a big company. I just want to end this video by saying that if you don't know what you're doing in the stock market, it's easy to make mistakes and lose your hard-earned money. So if you know that simply looking at a chart isn't good enough, you're already better off than 90% of the people out there. It's important to consider other factors that we mentioned earlier. So you need to look at the size of the company, the number of shares available, and the valuation. If you're trying to make money, it's important to not be lazy. You have to do your research and actually dig deeper. And by watching this video, you're already doing just that. So stay tuned for more content because later on, we will be going into the nitty-gritty details. Well, that's the end of the video. Thanks so much for watching. You can leave a thumbs up and subscribe to support the channel, and I'll see you next time.